Your $100,000 can become a digital workforce. No overtime, no sick days, just deposits. This is the shift from the employee mindset, watching prices and reacting, to the owner mindset, where you assign jobs to dollars and collect cash flow. It isn't a static savings goal, it's a living cash flow engine that averages about $295 a month right now and compounds into serious income. In the next minutes, you'll see the portfolio blueprint, SCHD's 3.75% anchor, blue chip shields from PG to J&J, a 5.67% monthly engine with realty income, and growth-oriented dividends to push raises. Now, how does $100,000 clock in daily and send you deposits? Let's talk about the mindset that makes that possible. Employee versus owner, turning $100,000 into a digital workforce. Here's the shift that makes it work. The employee mindset acts like a trader, tracking prices, scanning headlines, reacting to every bump. It feels busy, but it rarely builds steady income. The owner mindset assigns a clear job to each dollar and expects cash to show up on a schedule. You move from chasing outcomes you can't control to managing a system you can. Your role changes from trader to payroll manager. Josh learned this the hard way. The more he watched prices jump around, the less in control he felt. His days were tied to candles and alerts. When he pivoted to a dividend calendar, focusing on who pays, how much, and when, his stress dropped. The deposits didn't care about the day's news, and that predictability gave him a real agency over his plan. Most investors get pulled into the screen. They chase green candles, wait for perfect timing, and miss dividends that were available the whole time. That cycle is exhausting. It also leaks money. Every day spent trying to guess where prices go next is a day not spent setting up deposits that arrive whether you're paying attention or not. Think of your capital as a digital workforce. Every dollar gets a job description. Produce income on set dates and grow that income over time. The work happens whether you log in or not. You don't bargain with the market, you put your dollars under a policy that pays you, and then you enforce the policy with rules. You hire quality, you keep payroll lean, and you avoid workers that promise too much and don't deliver. Price charts look like noise. A dividend calendar looks like order. When you know the date checks land, your behavior changes. You stop reacting to red days because your bills aren't due to a candlestick. They're matched to deposits. Predictability reduces stress and increases follow-through. It also makes budgeting tangible, income tied to days, not moods. On day one, this plan targets about $295 per month from a $100,000 portfolio. That's the average across the year, not a promise of equal months. You don't need to refresh quotes to get it. The money shows up because you selected payers with schedules, coverage, and a history of writing checks. You can spend it on small recurring costs or reinvest it to build your future base. Most stocks pay quarterly, 4 times a year on a cycle. A select few pay monthly. That rhythm matters. Quarterly payers create peaks, then gaps. Blend in a monthly payer and you flatten those gaps into a smoother line. Stability isn't just about the annual total, it's about when it arrives and how that affects your decisions. To make this work cleanly, each dollar needs a seat. A 4-category engine does that. An anchor that steadies the ship, shields that defend cash flow through cycles, a monthly engine that keeps deposits consistent, and accelerators that push future raises. Next, we'll shape that structure so it can deliver stability today and raises tomorrow without a maze of tickers. Now we put the roles to work. Build the 4-category engine: anchor, shields, monthly engine, accelerators. You don't need a maze of tickers to get there. Use the 4 clear roles: an SCHD anchor for stability, blue chip shields for durable cash flow, realty income as the monthly engine to keep deposits steady, and a set of growth accelerators to drive raises over time. Each bucket does a job, and together they create a rhythm you can plan around. The $100,000 is split evenly into 10% positions across these 10 holdings, so no single stock or sector dominates the results. Most portfolios miss because they tilt too far. Go too safe and the income creeps forward without meaningful growth. Chase yield and you risk payout cuts and timing gaps that turn a steady plan into a guessing game. The goal here isn't maximum yield on day one. It's a reliable base that grows. That comes from quality screens, payout discipline, and a blend of sectors that don't all move in the same weather. Start with the anchor. SCHD targets about a 3.75% yield and uses aggressive, rules-based filters for financial strength, sustainable payout ratios, and consistent cash generation. You're buying an index of high-quality dividend payers spread across sectors, which helps smooth single-company surprises and keeps the income stream from relying on one industry. The anchor's job is clear. Keep the floor intact and deliver dependable checks while the rest of the engine does its work. Add the shields. Procter & Gamble, Coca-Cola, PepsiCo, Johnson & Johnson, and AbbVie bring long dividend histories and products people keep buying through cycles. Think cleaning supplies, personal care, beverages, snacks, and medicine, essentials that tend to hold demand in different market environments. These names won't always be exciting, but they tend to keep paying and often keep increasing, which supports both stability and built-in raises. Now, the monthly engine. Realty Income pays monthly with a yield near 5.67%. As a REIT, it collects rent from a wide tenant base and passes cash along as dividends. That monthly cadence fills the gaps between quarterly payouts from the rest of the portfolio, turning lumpy income into a smoother line. Timing matters for behavior. Consistent deposits reduce the urge to micromanage. Then, the accelerators. Air Products and Chemicals, Nexstar Media Group, and Consolidated Edison combine current yield with the potential to grow payouts. APD adds industrial stability with a track record of dividend increases. NXST brings media cash flows and a higher starting yield that has room to expand. ED, a regulated utility, contributes steady earnings and resilience in tougher markets. Their role is to push income growth without compromising the core. Keep the weighting even across the four buckets. That balance spreads risk, keeps the income base predictable, and leaves room for dividend growth to compound over the years. You're not betting the plan on any single company or sector. You're giving every dollar a defined role and a paycheck date to match. With the engine assembled, the next step is simple. Lay out the calendar so you know which checks land each month and how the pattern builds across the year. Your calendar is the control panel, your 12-month paycheck map. What hits and when starts with knowing the sequence, not guessing it. If you knew the dates money lands, would you still refresh your portfolio 10 times a day? Think of the year as 3 quarterly pillars with a monthly drip layered across them. You don't get identical months, you get dependable months. That's the difference between hoping for even cash and planning around known checks. Your income rhythm comes from blending payout schedules so the peaks cover the valleys and your bills don't care which week the market had a mood swing. Start with the floor. Realty Income pays monthly, so it acts like a baseline deposit. On a $100,000 setup using an even slice for the monthly engine, you're looking at roughly $47 arriving every month without waiting for quarter ends. That rent check smooths the ride between larger payouts and keeps your plan alive even in quieter weeks. It's not meant to carry the whole month. It's meant to make every month feel active. Now layer quarter one months: January, April, July, October. This set adds Procter & Gamble, Air Products and Chemicals, and AbbVie on top of the monthly deposit. In those months, you're collecting about $76 from Procter & Gamble, $78 from Air Products, and $78 from AbbVie, plus the $47 from Realty Income. These checks often land in the back half of the month, stacking into a reliable cushion. You'll notice these months feel fuller because you're collecting from consumer staples, an industrial with a raise habit, and a healthcare name known for strong, free cash flow. The combo raises your average without forcing you to hunt for extreme yields. Quarter 2 months: February, May, August, and November bring Nexstar Media, Consolidated Edison, and Johnson & Johnson into the flow. Here the structure shows up clearly. roughly $94 from Nexstar, $89 from Con Ed, and $65 from J&J, alongside the steady $47 from Realty Income. Media cash flow, regulated utility stability, and a diversified healthcare player keep the cadence going when other names are quiet. This keeps the rhythm between quarters and reduces the temptation to tinker. You're still getting the monthly Realty Income base, but these months get a structured boost that bridges the gap to the next pillar. Quarter 3 months: March, June, September, and December. Round out the cycle with SCHD, Coca-Cola, and PepsiCo. Expect about $94 from SCHD, $73 from Coca-Cola, and $98 from PepsiCo, plus the $47 from Realty Income. The Anchor ETF spreads risk across quality dividend payers, while the beverage giants add steady, branded cash. These months often feel balanced, not the biggest spikes, but consistent enough that your plan feels like a paycheck system rather than a surprise. Across the full year, the math works out to roughly $295 per month on average in year 1. The calendar, though, is the real win. Monthly base deposits fill the gaps, quarterly clusters deliver heft, and together they produce a pattern you can align with real expenses. You stop guessing and start scheduling, and once the map is clear, the next step is protecting it from the quiet mistakes that drain cash flow over time. Let's address the weak points that quietly undercut a dividend plan, 4 silent killers, and the fixes that keep cash flow alive. Most dividend plans don't fail loudly, they fade quietly. Here's where that happens. There are 4 traps that drain cash flow over time: chasing high yields, expecting monthly checks from most stocks, loading up on one sector, and leaving drip off. Each looks attractive at first glance: bigger headline yield, a smoother income idea, concentration in a hot industry, or taking cash now, but the long-run cost shows up in cuts, gaps, volatility, and slower compounding. Chasing yield is the fastest way to break a plan. A yield that jumps far above peers often signals stress, not generosity. Start with the payout ratio. As a guideline, healthy payout ratios usually sit below 60%, so companies retain a buffer for downturns and reinvestment. Go deeper than earnings and look at free cash flow coverage. Does operating cash consistently exceed dividends after necessary spending? When dividends outpace real cash generation, the board eventually has to choose between debt, dilution, or a cut. That cut doesn't just sting once, it resets your income base and can crater the share price, which lowers future compounding. Payout timing creates another silent leak. Most companies pay quarterly, so checks naturally cluster. Expecting even monthly income from a portfolio of quarterlies leads to frustration and unnecessary tinkering. The fix isn't grabbing risky monthly yield, it's adding a reliable monthly payer, like Realty Income, to act as a base while the rest of the holdings deliver their quarterly cycles. That simple blend reduces timing shocks without stretching for unsustainable sources. Under-diversification magnifies every problem. Concentrating in a single sector ties your income to one economic story. When that story turns, dividends wobble together. Spread exposure across consumer goods, utilities, healthcare, industrials, and real estate. Then add a quality-focused dividend ETF to knit them together. This mix stabilizes cash flow because each sector faces different pressures and demand patterns. One weak link won't dominate the paycheck. Skipping drip slows the whole engine. In the building phase, reinvesting dividends automatically buys more shares, and those new shares start paying their own dividends. It's quiet, mechanical growth that doesn't rely on fresh contributions. Over time, the compounding effect shows up as faster increases in total income, even if headline yields haven't changed. Drip also keeps you out of timing decisions that often backfire. Set guardrails to stay out of trouble. Avoid extreme payout ratios that leave no buffer. Favor businesses with consistent dividend growth streaks so raises become part of the plan. Turn on automated reinvestment by default while you're accumulating, and only switch off when you actually need the cash. Keep sector weights balanced enough that one theme can't derail the whole calendar. With these fixes in place, the structure is ready to compound. The next step is seeing how a base near $295 per month scales when every deposit quietly buys more income. Here's how that plays out over time. From $295 per month to $10,000 per month. The DRIP compounding trajectory. What starts as $295 per month can become a 5-figure monthly paycheck without adding more cash. Year 1 sets the base at about $3,544 in total dividends. That covers small recurring bills, while DRIP quietly increases your share count. Every reinvested dollar buys more of the same payers, which means next quarter's deposits rise without any extra effort. You don't need to micromanage it. You just need the system on and the distributions flowing back into more shares. Here's the hard part. Progress feels slow early. Dividend raises are incremental and reinvested shares barely move the needle at first. The real edge is patience, because most of the compounding shows up later. If you judge the plan in year 2, you'll miss the step change that shows up in the second and third decades when past reinvestments start paying you more than your original contribution ever did. By the end of the first decade, though, the effect is visible. Income has already doubled compared to year 1, even without new money. Fast forward to year 10. With DRIP active and steady dividend growth, total annual income can land around $10,000 or roughly $830 a month, and the portfolio value rises to roughly $288,000. What changed? Your dividends now own more dividend engines, the monthly deposits from realty income, the quarterly pillars, and the anchor's distributions all buy additional shares each period. Those new shares immediately join payroll, and your income base expands even if market prices wander. By year 20, the flywheel dominates. Annual income near $35,000, about $3,000 per month, comes mostly from dividends buying dividends, and the portfolio's valuation climbs to about $870,000. Raises from the companies stack on top of the rising share count, so your yield on cost climbs even if the quoted yield stays flat. At this stage, the compounding is visible. The months feel heavier, the gaps between quarters feel smaller, and your budget can lean more on the portfolio. By year 30, the machine looks different. Around $124,000 per year, about $10,333 per month, flows from a portfolio compounding to roughly $2.76 million. The largest gains arrive late because growth compounds on a larger base. A small percentage increase on a multi-million-dollar portfolio adds more income in 1 year than the entire first 5 years produced combined. Most wealth isn't created early on. It shows up in the later years when compounding fully takes over. The path isn't linear. The last decade often outpaces the first 2 put together. That's why sticking with the calendar matters more than chasing an extra half point of yield today. You want consistent raises plus automatic reinvestment working month after month. A quick mini case makes it concrete. DRIP on realty income means every monthly check buys more shares, which start paying the very next month. SEHD's quarterly distributions reinvest across quality names, so you accumulate even during flat markets. Dividend growers like Johnson & Johnson and Air Products lift payouts over time. When those raises hit a larger share base, your total income accelerates faster than headline yield suggests. Set it up once, keep the policy consistent, and let the schedule do the heavy lifting. Your role is to set roles, enforce the payout rules, and let compounding handle the raises. Now step into the owner mindset for real. Move from trader to payroll manager of your digital workforce. Treat your dollars like employees. Give each a role, set a payout schedule, and keep the system running. Assign the anchor, shields, monthly engine, and accelerators. Then keep the calendar steady while DRIP increases share count in the background. Year 1's $3,544 total, about $295 a month, is the enrollment phase. You're onboarding workers to replace a full-time paycheck over time. Now act. Build the 4-category engine, turn on automatic reinvestment, and draft your 12-month dividend map so bills meet deposits by design. Next, we push this portfolio through stress, recession rate shock, and test where to add without breaking the rhythm.